Welcome back to the deep dive. We're doing something a little bit different today.
Here we are.
Usually when we talk about financial markets on here, we are wading through these really dense white papers or earnings reports.
Right, or some heavily academic economic theory.
Exactly. And look, we know you guys are smart. You listen to this, you track the markets, you know the difference between a bull and a bear.
You know the jargon.
Right, the jargon. But be honest with me for a second. If I put you on the spot right now and I asked you for the actual the mechanical difference between owning a stock and trading a future.
Without using any buzzwords.
Without the buzzwords, could you explain it?
It is honestly the ultimate dinner party trap.
Oh, totally.
You hear people tossing these terms around all the time, like, oh, I'm long Apple today.
Or I'm short oil futures.
Exactly.
Yeah.
And everyone just kind of nods along. But the actual plumbing of those two things, they're worlds apart.
Completely different universes.
And frankly, the financial industry really benefits from that confusion. Complication keeps the management fees high.
That is the perfect setup for the document we are tearing into today. We found this source material that cuts through all of that complexity, and it does it in the most unexpected way.
It really does.
It's titled The Simple Child's Guide to Stocks and Futures Trading.
Which I know sounds a bit ridiculous.
Right. Before you roll your eyes and think this is some baby book, it isn't.
Yeah.
It is actually a brilliant piece of deconstruction.
It really is.
It uses these really vivid analogies. We're talking pizza, lemonade, bouncy castles, and it uses them to explain concepts that usually require a Series 7 license to even wrap your head around.
What I love about this approach is that it just strips away all the ego.
Yes.
When you look at sophisticated financial instruments through the lens of a 10-year-old, you have to stop focusing on trying to sound smart.
You drop the jargon.
Exactly. You
Yeah.
drop the jargon and you start seeing the actual mechanics of risk and reward. It forces you to look at the bare metal of the market.
So that is our mission for this deep dive. We are going to take this guide and use it to re-examine ownership, expiration, and the absolute weapon that is leverage.
It is a weapon.
We aren't just defining terms here. We are going to see if these simple analogies can actually save you from blowing up your portfolio.
Let's jump right into the first core concept then.
Let's do it. The difference between owning a thing and promising to do a thing.
This is the foundation of everything.
Yeah.
The guide distinguishes between what it calls the pizza and the lemonade stand.
Right, the Apple pizza. I have to say, as a mental model, it is incredibly sticky.
It works perfectly.
The guide says to imagine Apple, the trillion-dollar company, is just a giant pizza, and it's cut into 1 billion slices.
Okay.
Buying a stock is simply buying one of those specific slices.
It sounds so basic, really. But dwell on the actual implications of that for a second. When you buy that slice, you have a claim on the physical asset itself.
It is tangible.
Very tangible. You own it, you can put it in the fridge, you can eat it, you can sell it to your neighbor.
The key word there is asset.
Right. In the adult world, that means you have equity. You have a literal vote. If the company dissolves tomorrow, you technically have a claim on the chairs and the monitors left in the office building.
And the guide brings up dividends right here too, which I loved. It calls them extra toppings.
Which is such a perfect way to view passive income.
Because you aren't doing any of the work.
None at all. You aren't to the back flipping the pizza dough. You aren't taking orders.
You just hold your slice on a paper plate.
Exactly. And because the pizzeria had a highly profitable year, someone just comes by and throws extra pepperoni onto your plate.
For free. Just for holding it.
Just for being an owner. It really highlights the passive nature of stock ownership. You are a participant in the success of the business without being an active laborer.
Okay, so stocks are stuff. You own the stuff.
You own the stuff.
Now let's shift gears to futures. Because this is where the guide introduces the summer lemonade stand.
This is where we shift from holding an asset to holding an obligation.
Right. So in this scenario, you are not buying a cup of lemonade. You are walking up to the neighbor's stand and you are making a pinky promise.
A legally binding pinky promise.
Right, a promise to buy lemonade in exactly 3 months for $1 a cup.
Regardless of what the actual price of lemons does in the meantime.
That is the critical distinction. You just shake hands.
And that handshake is the futures contract.
Just the handshake.
Now pause and think about what you actually have in your pocket in that exact moment. Do you have any lemonade?
No, I have absolutely nothing. I'm thirsty. I just have a deal.
You have a liability. Or if you want to be super technical about it, a contingent claim.
Right.
You haven't paid a single penny yet. And you haven't received a single drop of juice. You have simply entered into a timeline.
A timeline. I like that.
Yeah.
The guide really emphasizes that the handshake itself is the product you are trading.
Yes.
This is what I found so interesting about the framing here. It clarifies that futures are not about investing in a company at all.
Not even a little bit.
They're entirely about price discovery and transferring risk. Because if I'm the neighbor running the stand, why on earth would I agree to sell it to you for $1 in 3 months?
Well, maybe you are terrified that lemon prices are going to crash.
Right.
And you want to lock in your profit margin today so you don't go out of business.
So the seller is hedging.
Hedging their risk. And you, the buyer, are the speculator. You are betting the price goes up to $2 and you get a bargain.
But structurally, we are just swapping promises.
That is all it is.
Yeah.
There is no equity. There are no pepperoni toppings or dividends coming your way. It is a zero-sum game.
Meaning for me to win, you have to lose.
Exactly.
Which brings us to the element of time. Because the guide compares stocks to diamonds and it compares futures to milk.
It is a really strange grocery list, but it is highly effective.
Stocks are diamonds because they are forever.
Well, effectively forever.
Right. The guide mentions Warren Buffett here.
Yeah, holding positions for, what, 60-plus years?
Exactly. When you buy a stock, time is generally working in your favor. If the market crashes tomorrow, you don't have to do anything. You can just close your eyes, wait 5 years, and often you'll be completely fine.
You have the luxury of patience because the diamond doesn't degrade.
Unless the company literally goes bankrupt, the asset is distinct from the immediate market cycle.
Right.
But futures are milk. They spoil.
They have a death date.
A death date.
The industry calls it expiration, but I honestly like death date so much better because it captures the absolute fatality of it.
It's a final.
Every single futures contract, whether it's for crude oil, corn, or the S&P 500, has a specific day where it ceases to exist in the market. March 31st, for example.
And this completely changes the psychology of the trade. You cannot just wait it out if you are wrong.
You absolutely cannot. If you are long, meaning you bet the price would go up, and the price is down on expiration day.
You lose.
You lose. Game over. The contract settles right then and there.
You don't get to call your broker and say, hey, give me another week for the market to bounce back.
The milk has gone chunky. You have to throw it out and take the loss.
And this brings us to the part of the guide that honestly gave me a little bit of anxiety just reading it.
The nightmare scenario.
Yes, the nightmare scenario. We've established that a future is a legally binding promise to buy a physical thing.
Right.
So what happens if you just forget to cancel the promise before that death date arrives?
This is the physical delivery clause. And look, this is the stuff of urban legends in the trading pits, but it is a very real mechanic of the market.
The guide tells this story about a trader and crude oil. Walk us through how this actually happens.
Okay, so you have to understand, most people trade futures entirely electronically.
Just numbers on a screen.
Exactly. They're just moving pixels around to make cash.
Yeah.
They have zero intention of ever actually owning the underlying physical commodity.
Right. Nobody wants a silo of wheat.
Right. But the contract itself is legally a commitment to take delivery of the physical good. If you hold that contract past the closing bell on the expiration date, the mercantile exchange assumes you want the product.
So the computer system just says, okay, this guy promised to buy the oil, let's send him the oil.
Correct. The story goes that a retail trader just forgot to close out his position on a Friday. He wakes up Monday morning to a very stern notification that he is now the proud owner of 1,000 physical barrels of crude oil.
1,000 barrels. I actually did the math on this while reading. That is roughly 42,000 gallons of oil.
Oh, wow.
You can't exactly put that in your swimming pool.
No, you cannot. The logistics of that are an absolute nightmare.
You need a fleet of trucks.
You have to arrange tanker trucks, commercial storage facilities, hazardous materials insurance, and you have to do it right now.
Because it's waiting for you at some depot in Oklahoma.
Exactly, Cushing, Oklahoma. The exchange does not care that you clicked the wrong button or that you made a mistake. You sign the handshake.
It really highlights how serious these instruments are. They aren't just video game tokens.
Yeah.
They connect directly to the real physical supply chain of the planet.
It drives home the difference between an asset and an obligation.
Yes. If I forget about my Apple stock for a year, I might get a nice dividend check in the mail.
But if you forget about your oil future, you get an industrial environmental hazard delivered to your front lawn.
That is the perfect summary. One is passive wealth. The other is active liability.
Absolutely.
Okay, let's ramp up the intensity here.
Right.
We have covered time and ownership. Now we really need to talk about the primary mechanism that draws everybody to futures in the first place.
The giant slingshot.
The giant slingshot. We are talking about leverage.
Leverage. The absolute siren song of the financial world.
the guide contrasts this with stocks by using a vending machine versus a bouncy castle analogy.
I love this one.
With stocks, it is like a vending machine. It's linear. The guide says what you put in is what you get.
Right. If you have $10,000 in cash, you can buy exactly $10,000 worth of stock. It is very simple math.
Right.
If the stock goes up 10%, you make $1,000. It is a straight one-to-one relationship.
But the bouncy castle, this is where the math gets genuinely wild.
The bouncy castle represents this concept of control versus payment.
Okay.
Imagine you are renting a huge bouncy castle for a kid's birthday party. The castle itself costs $1,000 to buy outright.
But I'm not buying it.
Right. You are just renting it. So you only have to put down a $50 deposit to have it in your yard for the entire weekend.
So I have total control of a $1,000 asset, but I only use $50 of my own money.
Exactly. You are controlling a large asset with a tiny fraction of capital. In the futures market, this deposit is called margin.
Margin.
And the ratio you get is staggering. Let's look at the actual numbers the guide breaks down. Take a standard crude oil contract.
Okay.
The total value of the oil in that one contract might be roughly $50,000.
50 grand. That's a lot of money.
It is. But to control that entire contract, to have all 50 grand of it sitting in your portfolio, the exchange might only require you to put down $5,000 of your own cash.
So that is 10-to-1 leverage.
10-to-1.
Let's play that out so we can really see the impact. Say I have $5,000 in normal stocks.
Okay.
And the stock market moves up 5%. I make $250.
Nice little profit, a good dinner out.
Right. But if I take that same $5,000 and I use it as margin to control $50,000 of oil.
And oil moves up that same 5%.
5% of the $50,000 is $2,500.
Ooh. You just made a 50% return on your initial cash, all from a tiny 5% move in the actual asset.
That is intoxicating.
It is.
I can completely see why people quit their day jobs to go day trade this stuff.
It feels like pure magic when it works. It feels like you found a cheat code for money. But the guide specifically calls leverage a lightsaber for a very good reason.
Because it is incredibly powerful, but you can easily cut your own arm off.
Or much worse. Because the math works exactly the same in reverse.
Yeah.
And people always forget this part.
Oh, wow. So if oil drops just 5%,
you lose $2,500.
Half of my entire account is just gone instantly.
Instantly. And a 5% move in commodities, it's totally normal Tuesday. It is a mild move. What if oil drops 10%?
Then I have lost $5,000. I've lost 100% of my money. My account is at zero.
Right. And what if it drops 11%?
Wait.
Now you have lost more money than you even started with. You actually owe the broker a check.
That is terrifying.
This is what new traders do not understand about the slingshot. It doesn't just shoot you forward. If you slip, it snaps back and takes your head completely off.
This leads so perfectly into the section on barriers to entry, because the guide uses the analogy of layaway at a department store to explain margin.
It's a great comparison.
And it sounds so accessible at first, like, hey, come control a fortune for just a few grand. But is that level of accessibility actually a trap for regular people?
It absolutely can be. Look at the capital efficiency argument first. For a professional, say you are an airline company like Delta trying to hedge your jet fuel costs.
Right.
Or you are a massive billion-dollar hedge fund. Futures are amazing tools. They allow you to manage huge global risks without tying up all of your operating cash.
That makes sense. If I'm Delta Airlines, I don't want to spend millions in cash actually buying physical oil today and storing it.
No, you just want to lock in your price for next year, so you put down a deposit.
Just a margin deposit.
Precisely. For institutions, it's just an efficiency tool. But for the retail trader, the regular person reading this guide, it is very often a trap. Look at the entry prices, the guide lists for the S&P 500 futures.
Yeah, I saw that. You can control $500,000 of the U.S. stock market for a deposit of about $12,000.
$12,000 in margin.
That is terrifyingly accessible. If you just have 12 grand sitting in a savings account, you can technically wield a $500,000 position in the market.
And that brings us directly to the margin call. The guide frames this as the store manager calling you on the phone about your layaway item.
Saying you need to pay up.
Right. But in modern electronic trading, it is so much more brutal than a phone call.
How does it actually work in reality? It's not some guy in a suit on a telephone anymore, is it?
No, not at all. It's an algorithm. Let's say you are leveraged to the hilt on that S&P contract.
Okay.
and the market takes a sudden dip against you, just a temporary drop. Your account balance falls below the minimum required margin to hold that massive position.
So my deposit isn't big enough anymore.
Exactly. The broker's computer system wakes up in a millisecond and says, risk detected.
Wow.
Does not email you. It does not ask you nicely to please deposit more funds by Friday. It just liquidates you.
It just sells your entire position.
Sells it at the current market price.
Which is the worst possible moment because the market is down.
Instantly sold. It flushes you out to protect the brokerage firm from taking a loss.
So you could be totally right about the long-term direction.
Yes.
Maybe the market is going to shoot up to record highs next week.
That happens all the time.
But because of that tiny dip today, you got wiped out. You just didn't have the staying power.
That is the key difference right there. Staying power. With the Apple Pizza stock, you can ride out a bad storm.
You just hold the slice.
With the bouncy castle future, if the wind blows a little too hard, the rental company comes into your yard and takes the castle away immediately.
And they keep your deposit.
They keep every penny.
Man, to wrap this all up, the guide uses this little narrative device at the end, the tale of Tommy and Sarah.
I really like this part.
I think it really humanizes all these cold mechanics we have been discussing.
It puts a face on the actual psychology of trading.
So Tommy is our stock investor.
Right. Tommy goes out and buys one single share of Coca-Cola for $60. He officially owns a tiny piece of the company.
He is an asset.
He is just patiently looking for his extra toppings in the form of quarterly dividends. And his time horizon is essentially someday.
Honestly, Tommy sounds kind of boring.
Tommy is incredibly boring. But Tommy is safe.
That's true.
If the stock market closes for a week because of a glitch or crashes 10% on a bad news day, Tommy just sighs and goes back to playing golf.
He doesn't owe anybody any money.
Right. He has an asset. It might be worth a little less today, but it's still his.
Now, contrast that with Sarah. Sarah is the futures trader.
Sarah is in the arena. Sarah signs a futures contract for 1,000 gallons of frozen orange juice.
Okay.
The current price is $2 a gallon, so it is a $2,000 contract in total. But she only puts down $500 as margin.
So she's leveraged 4-to-1 on orange juice.
Right. Now look at her day-to-day life compared to Tommy. Every single penny the price ticks up or down matters intensely.
Because of the leverage.
Yes. If orange juice goes up to $3, she makes $1,000. She doubles her money on a $500 deposit. She feels like an absolute genius.
But if it drops to $1...
She loses her entire $500 deposit, and she owes the broker another $500 on top of it. She is underwater.
Oh.
So Sarah is glued to her computer screen. She can't sleep because the Asian markets might open in the middle of the night and move the global price of oranges.
She is living with a ticking clock.
A ticking clock and a loaded weapon.
It sounds totally exhausting.
It's high-performance stress. And you have to remember, for every Sarah making a fortune on a trade, there is another Sarah on the exact opposite side of that screen losing a fortune.
It's zero-sum.
Futures are just a transfer mechanism. Wealth isn't created there the way it is when a company grows. It just moves rapidly from the impatient to the patient, or from the unlucky to the lucky.
So if we zoom out here, the Child's Guide isn't really just teaching us financial vocabulary.
Oh, not at all.
It is forcing us to ask what kind of game we actually want to play with our money.
That is the real lesson of the document. Are you looking for ownership and slow, steady growth? Then be a Tommy.
Buy the pizza.
Are you looking for hedging, wild speculation, and the pure adrenaline of leverage? Then be a Sarah. But whatever you do not try to be a Sarah with a Tommy mindset.
Because you will get absolutely crushed.
You will get liquidated before lunch.
And don't mistake the simple analogies for safety either. Just because we are calling it a bouncy castle doesn't mean you won't break your neck.
In the financial markets, the bouncy castle is easily the most dangerous thing in the backyard.
So for everyone listening to this deep dive, here is the big takeaway. The next time you hear about futures or commodities on the news, don't just think of lines on a chart.
Right.
Think about the pinky promise handshake. Think about the ticking clock on that carton of milk, and really ask yourself, can you handle the expiration date?
And beyond just your own portfolio, consider this thought too. The entire global economy actually relies on Sarah taking Tommy's risk.
What do you mean?
If Sarah doesn't exist to step into the arena and take on that crazy leverage risk, the farmer can't guarantee a price for his oranges.
Oh, wow.
And if the farmer can't hedge his crops, he might not grow them at all. So the wild speculator, the one dealing with all that stress, is actually the unseen foundation of your local grocery store.
That is wild to think about. Your morning glass of juice only costs what it does because some trader in Chicago is willing to hold the ticking clock.
Exactly. Even if you never trade a future in your life, they dictate the price of your breakfast.
Oh, and honestly, ask yourself if you really want 1,000 barrels of crude oil dumped on your front lawn.
I definitely do not have the local zoning permits for that.
No, I highly doubt your neighbors would be thrilled.
That is going to do it for this deep dive. We really hope this child's guide helped you see the very adult world of finance a little more clearly today. Thanks for hanging out with us, and we will catch you in the next one.